the Surgeon General said buying stocks can be injurious to your health. But on a more serious note, buying a stock is a far more complicated activity than most people seem to think. So what's happened with the development of markets is on a smartphone or a tablet or a laptop, we can in seconds buy one of thousands of companies. And there's no effort required to buy a stock, no effort required to sell a stock. But in order to do well, one really needs to understand the underlying business and to have a point of view on kind of where that is versus the market capitalization. So I'll give you an example. Many times in the US, like I'll go to my health club, for example, and one of the members will ask me, hey, Mohnish, should I buy Apple? Should I buy Apple stock? And I turn the question around to them. I say, hey, John, what's the market cap of Apple? And they look at me with a puzzled look. They said, the stock is at 170. I said, no, what is the market capitalization? And they don't know. Okay, so the first thing, if you're going to go buy some rice in the market, you're going to know what is the price per kilogram. So the first thing is that if you're going to buy a stock, at least know what you can buy the whole company for. And most investors don't have that knowledge, which is amazing. And so the first thing an investor ought to ask themselves before they buy a stock, even before we get to price and so on, is this within my circle of competence? Now, circle of competence is a very important concept, one of the most important concepts in investing. A person like Warren Buffett would consider something like 95% of stocks outside his circle of competence. And he says that, probably 97, 98% of things that show up on his desk go into a box called the too hard pile. He can't figure them out. Okay, so there's just a sliver of businesses. Now, if Warren Buffett can't figure out 95% of businesses, for the rest of us humans, we can't figure out 99% of them. So most things are going to be outside the circle of competence of most investors. So now let's say an investor answers the question correctly. Yes, I understand Apple, and I understand it's within my circle of competence, right? So the next question then comes up is the question I asked. What could you buy the whole company for? And then the second question an investor should ask is, so let's say an investor knows Apple is worth $1 trillion, for example. So the question I would ask them is that if your family had a fortune of $4 trillion, would you be willing to put 1/4 of that fortune into Apple? And if the answer is yes, buy the stock. If the answer is no, don't buy a single share. And so these are just very simple, which is, look at your net worth, look at your family's fortune, and are you willing to put 1/4 of it buying the whole company that you want to buy 100 shares of? And so these are basic things that most investors, unfortunately, don't focus on.
Yeah.
And so I feel that investing in stocks, figuring out, what they're worth, what your circle of competence is, these are complicated issues. So for most investors, it's a really good idea to index. Because indexing, you can buy a Nifty 50 index or any broad index in India for basis points. The frictional cost for ETFs and all is very low. And the second is you average out over time. So every month when you get your salary check, take a small portion, first put it into savings, and then don't worry about it. What I would say, set it and forget it.
Fill it, shut it, forget it. The
Yeah.
Hero Honda ad.
Yeah, exactly. And so that's why I think that buying stocks should really be an exception rather than the norm.
Most of the times when I'm looking for an idea, I need the idea to scream at me saying, buy me. Until then, I don't go out
in
buy.
the US, we have these wooden things called 2x4s,
okay,
which we use in housing construction. I need to be hit on the head by a 2x4 before right. I should buy a stock. Yeah. So before buying a stock, it has to be a complete and total no-brainer.
Okay.
If I have to turn on Excel, it's an automatic rejection. if I cannot describe the idea to a 7-year-old in 2 or 3 minutes, it's an automatic rejection. It needs to be painfully obvious to the village idiot why we should be buying.
Where are such opportunities currently in such an overheated market? And okay, let me rephrase. I'm not using the term overheated loosely. I'm just saying the markets have rallied. We may not be in bubble territory for certain markets, and all of that is a subject of everybody's individual opinion. Only future will show whether we were there or no. But let's assume for a moment's sake we are not in bubble territory, but we are in a space where the markets are at worst fairly valued. You will probably not get opportunities wherein you get hit by a 2x4.
Well, we are in wonderful Lower Parel right now, and within, I would say, 10 or 15 kilometers of Lower Parel, from here to the next 15 kilometers, is a boatload of opportunities in real estate.
Okay, fine. I didn't want to get down to real estate so soon. We'll get to that. But you, even right now, what I'm trying to find out, Mohnish, is that you are still in a market like this, looking for ideas which are just too painfully obvious. You're not.
Well, I think even in rampant bull markets, there are always misunderstood businesses. Now, rampant bull markets will cause a lot of overpricing, and I think a lot of things are overvalued. But there are plenty of things that may be fairly or deeply undervalued. In a market like India, with 5,000 listed companies, more than 5,000 listed companies, it is just not possible in auction-driven markets that all of them are efficiently priced. Sure. We are going to have underpricing and we're going to have overpricing, just the nature of the beast.
Okay. The reason why I asked this question is a lot of your peers, a lot of people within the same space. We did a small series with Ramdev Agrawal sometime back in
Wonderful
Bali.
Guy, good friend.
Yeah, okay. So, and Ramdev says often that I find value in growth. So the stock may not be underpriced or may not be a screaming buy, but if there is growth that he sees over the period of 4, 5, 6, 10 years, maybe more, and there are other factors attached to this, by the way, viewers, not just growth itself, then that becomes an opportunity too. Are you looking for such opportunities in India? Because India is per se a growth market.
You are definitely better off buying a growing company over a cheap no growth company.
Okay.
So if I buy an asset that is cheap, that has very limited growth, all I'm going to do is cover the gap between, it may be worth 100 rupees a share, I'm getting it for 50, 60 rupees a share. I'm just going to make the 40 or 50 rupees over whatever period of time it takes to get there. Now, if I'm buying a company that has secular tailwinds, great management, and long growth engines, as long as I'm not paying up too much, it's the best place to be.
Okay.
And so I think Ramdev, in my opinion, is one of the best investors in the country. And I think, the only I would say critique I would have Ramdev is a tad too optimistic at times. But he's got it absolutely right that you bet on the growth engines and you bet on the long-term secular growth engines. Buying is complicated, selling is 10 times more complicated. Okay, so when we're trying to buy, relative to selling, it's relatively straightforward. We want to know what the growth engines are. If we're going after a growth company, we want to know what we're paying for that growth, and we want to try to figure out where is this company in 5 years or 10 years versus what we're paying for it. And so those are relatively straightforward compared to the selling question. The selling question is a more complicated question because one of the things we're forced to do is we're forced to look out into the future, maybe a few years out, to try to figure out what is the future of this business. And for most companies, even the insiders have a very fuzzy idea about the future. And so the thing is that if we buy a compounder at a value price, that's a relatively easy exercise because we're not paying up. But the difficulty comes in when it goes up in price and it looks fully priced, but still has a lot of tailwinds and still has great management, still has a lot of great growth in front of it. So the best that I've been able to answer the question is a great company with great growth, with great management, give them some leeway. So don't sell them when they're fully priced. Don't sell them when they're overpriced. sell them when they're egregiously priced.
Okay.
Now, what each of these levels are, I'll leave to the viewer, but it should be obvious. When is it fully priced, when is it overpriced, when is it egregious? So what I've learned, one of my biggest mistakes has been is selling too early. I have watched 100 baggers that I bought who went on to become 100 baggers so many times after I was out. And I'd only captured the double or the triple, and I didn't capture the remaining 98 or 97 times that it went up.
But when you buy, you don't know it's going to be a 100 bagger.
Absolutely. In fact, you learn about a business only after you own it. We're not talking about the speculators and traders.
Sure.
So more power to them.
More power.
But when we come to investors, I actually find plenty of pundits on TV who have done fundamental analysis, and they give targets and they give stop losses, and I find that really peculiar. So the nature of markets. So one of the reasons why we can make a lot of money in equity markets is because they're auction driven. And auction-driven markets are very different from almost any other kind of market. So to give you an illustration, let's say I bought a flat in Mumbai for 1 crore. I don't know if we can get one for 1 crore or not, but let's play along. We got one maybe in the periphery of Mumbai. Okay, so we paid 1 crore for the flat, and we did research and we found that it's the right price and we bought it. And now we want to know how the price of that flat changes every day. So I have a friend who's a real estate broker, and I tell my friend, the real estate broker, listen, we're going to have chai with Pabrai every day. You and I are going to have a cup of tea. And every day just come and tell me what the market price of my flat is. Okay, so you bought the flat, next day you invite your broker friend, and he says, so I ask him, so what's the price of my flat? He'll say, listen, idiot, it's still 1 crore. Okay, I call him after 2 days, he still says, still 1 crore. And after maybe 2 months, he says, the little change in transactions, it's actually 1.05 crores now. It's 1.005 crores. It's gone up a little bit. And if you did this every day and you just wrote down the price he was giving you and did it for 365 days, you would, at the extreme end, find that it went to somewhere between 95 lakhs and maybe 1.1 crores or 1.15 crores, in that range. Right now, let's say my flat is a listed company on the Bombay Stock Exchange, but the only asset is this flat. And every day the price is doing whatever it's doing in the market. And we chart that daily price movement. What we're going to find is in a 52-week period, the range may be something like between 70 lakhs and 1.3 crores. And the reason is that auction-driven markets undershoot and overshoot. And it is the undershooting and overshooting that creates the opportunity for people like me, right? And so basically, the idea of a stop loss would be like I bought the flat for 1 crore, and so after 6 months, my broker tells me, prices have dropped about 5%. And I say to him, okay, that's my stop loss, and I'm now going to sell you my flat for 95 lakhs. Please sell it, right? It would be the equivalent of doing that. The reason you bought the flat for 1 crore because you thought that was fairly priced, and the second reason you bought it because you wanted to hold it as a long-term asset. So the same thing with stocks. If you bought a stock for 200 rupees or it has a market cap of 1,000 crores, you bought it because you thought it's worth 2,000 crores. So if it goes from 1,000 crores to 900 crores, you will sell it with stop losses, and it makes no sense. So I own a company called Rain Industries, right? And I bought that stock about 2.5 years ago. And when I was buying the stock, it was at about 30 rupees a share. And by the time I finished buying, it got up to 45 rupees a share. Went up almost 50% because I almost bought 10% of the business. And after I finished buying, it proceeded to go down. Just like everything I buy. Okay, the stock knows I bought it and it decides, Mohnish is done, now let's go down. Okay, if I had engaged in stop losses, Rain went down to 40, even went down to 35 after I finished buying, and I did nothing. And so now Rain is north of, 360 rupees. And so that whole opportunity would have been gone. it would have been no sense for me to put a stop loss at 30 or 35 or 40 because I thought it was worth a lot more. So I think investors ought to focus on making sure that the stock is within the circle of competence, that it's worth a lot more than it's valued at, and once you have those two things, a stop loss makes no sense.
Wow.
When I look at the markets in India and so let's focus on India first. So, but if I look at let's say the 200 largest names in India, I don't see screaming bargains. In fact, I see some very stretched valuations amongst those names. Very good companies, good tailwinds, and they may still become much more valuable in the future, but they're not obvious. And I focus on the obvious. So these are not no-brainers. These are not shooting fish in a barrel. They may be too overpriced. They may take a stumble. So it's not an area that's of interest to me. Okay. And I think in India, the interesting thing is that there are lots of companies that are less than 500 crores, 700 crores market cap, under-followed, under-researched, great entrepreneurs, great tailwinds. That universe requires some digging and some lifting to try to understand those businesses. There's also a lot of useless companies in that in that cesspool, if you will. But in that cesspool, there are also 50 baggers of the future, 100 baggers of the future. So my perspective is, I think of myself as a gentleman of leisure. I'd like to understand some of these businesses. I'm not assuming that I'm going to find something, but if we find something and suddenly 7 moons line up, we are happy to take a swing.
Okay, my last question to you. Aside of what we're seeing within the obvious pockets, and we've known about these, the rain industries and the real estate, are there other pockets of interest within India? People would want to know if there are themes or if there are sectors where you think there is an opportunity where people can, where people, having studied the businesses well enough, can invest into.
Yeah, see, I think the biggest thing India has going for it is the growth engine, right? So if an economy is growing at 6, 7, 8% a year, in that type of range, a lot of companies get natural tailwinds to grow at multiples of that. So Ramdev would say if the economy grows at 7%, private banking will grow at 14%, for example. And so there are these multiplier type opportunities. I mean, I see that let's take a asset class like asset management. I think asset management will grow at multiples of GDP growth. But at least I haven't found obvious bargains. So it may well be that the growth engines are so strong in asset management that even if you're playing 30 times earnings, there may be a bargain. But a person like me has difficulty with those types of numbers, right? So I can see many areas in India which look great for the future. The issue is that the valuations don't make them obvious. And so what I'm looking for is just be a gentleman of leisure, keep taking in the data, keep learning, and then once in a while you might find an anomaly. So I feel I was lucky in the last 1 year that real estate was an area that turned out to be a good one. I am not sure at this point if in 2018 I'll find anything. At this point, I haven't come up with anything. There's no buy list I have in India.
Don't forget to like and subscribe. Don't forget